Have you ever wondered how the stock market actually works? Not the complicated version with financial jargon, not the confusing charts, just the simple truth. Because once you understand how the stock market works, money starts to make sense, wealth starts to make sense, and opportunities start to look very different. At its core, the stock market is simply a place where ownership is bought and sold. That's it. It's not magic. It's not gambling by default. It's a marketplace. Just like a farmer's market where people buy and sell fruits, the stock market is where investors buy and sell pieces of companies. Let's start from the beginning. Imagine a company that wants to grow. Maybe it's a technology company that needs money to expand. Instead of borrowing all that money from a bank, the company can decide to sell ownership to the public. This process is called going public. When a company goes public, it offers shares. A share represents a small piece of ownership in that company. When you buy one share of a company, you literally become a partial owner. Not the CEO, not the decision maker, but an owner. If the company grows and becomes more valuable, your ownership becomes more valuable. If the company struggles, your ownership decreases in value. So how do prices move? Stock prices move based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. It's that simple. Prices are constantly changing because investors are constantly reacting to news, earnings reports, economic data, interest rates, and even emotions. Now here's something powerful. The stock market is driven as much by psychology as it is by numbers. Fear and greed move markets. When investors feel optimistic about the future, they buy aggressively and prices rise. When they feel scared, they sell and prices fall. That's why markets can swing up and down, even when nothing dramatic has changed in the real world. But what actually gives a stock value? A company's value is based on its ability to generate profits now and in the future. Investors look at revenue, earnings, debt levels, growth potential, and competitive advantage. If a company is expected to make more money over time, investors are willing to pay more for its shares today. However, short-term price movements don't always reflect true value. Sometimes prices rise too high because of hype. Sometimes they fall too low because of panic. That's why long-term investors focus on fundamentals instead of daily noise. Now let's talk about how regular people participate. You don't have to physically go to Wall Street. Today, stock exchanges like the New York Stock Exchange and NASDAQ operate electronically. When you open an investment app and press buy, your order is sent electronically to the market. Within seconds, you own a share. But here's where many beginners get confused. There are different ways to invest in the stock market. You can buy individual stocks. That means you're investing in one specific company. If that company succeeds, you win. If it fails, you lose. This approach can be powerful, but it also carries risk. The second way is through ETFs and index funds. Instead of buying one company, you buy a collection of companies bundled together. For example, an S&P 500 index fund allows you to invest in 500 of the largest companies in the United States all at once. This spreads your risk. If one company struggles, others may perform well. Diversification reduces volatility. Now let's address the big fear: crashes. Why does the stock market crash? Crashes happen when fear spreads quickly and investors rush to sell. This can be triggered by economic recessions, financial crises, rising interest rates, wars, or unexpected global events. When selling pressure overwhelms buying pressure, prices drop sharply. But here's the key lesson: crashes are temporary. If you look at history, The stock market has gone through multiple crashes, and yet over decades, it has continued to trend upward. The reason is simple. Businesses innovate, economies grow, productivity improves. Over long periods, growth has historically outweighed temporary downturns. This brings us to one of the most important concepts in investing. Time in the market beats timing the market. Many people try to predict when prices will rise or fall. Even professionals struggle to do this consistently. Instead, long-term investors focus on staying invested and allowing compounding to work. Compounding is when your money earns returns, and then those returns earn returns. Imagine you invest $1,000 and earn 10%. You now have $1,100. Next year, you earn 10% on $1,100, not just the original $1,000. Over time, this snowball effect becomes powerful. The earlier you start, the stronger compounding becomes. Now let's talk about risk. The stock market is not risk-free. Prices fluctuate daily. Some companies fail, some industries decline, but risk is reduced through diversification, long-term thinking, and consistent investing. The biggest risk for most investors is emotional decision-making, selling during panic, buying during hype, chasing trends. Successful investors understand that volatility is normal. A 10% drop is common. Even 20% corrections happen regularly. But historically, patient investors who stayed invested through downturns have often been rewarded. Another important point is that the stock market is not the economy. Sometimes, the economy looks weak, but the market rises because investors expect future improvement. Other times, the economy looks strong, but markets fall because expectations were too high. The market is forward-looking. It prices in what investors believe will happen next, not just what is happening today. So how should a beginner approach the stock market? Start simple. Focus on broad index funds or ETFs. Invest consistently every month. Avoid trying to get rich overnight. Ignore daily headlines. Build a habit instead of chasing excitement. Think of the stock market as a tool. It's not a lottery ticket. It's not a casino. It's a wealth-building machine, powered by ownership and time. When you invest, you're betting on innovation. You're betting on human progress. You're betting that businesses will continue solving problems and creating value. And historically, that has been a strong bet. The biggest difference between people who build wealth and people who don't is not income level. It's participation. Many people sit on the sidelines out of fear. Others start small and stay consistent. The stock market rewards patience, discipline, and long-term thinking. It punishes panic and speculation. So how does the stock market work? It works through ownership. It moves through supply and demand. It grows through profits and innovation. And it rewards those who stay invested long enough for compounding to do its job. If you understand that, you understand the foundation of wealth building.